Good morning, Ed Mines with the clown face. Good to see everybody. All right. So once again, if you're not joining us before 9:30, you are someone else's exit liquidity. And as I said, I don't like to hold shorts over the weekend. And this is the reason why. It's not necessarily that there is a policy change. There, obviously, we're still trying to figure out what's going to happen with U.S. trade. But it really comes down to what funds can do in the pre-market. And as we will see momentarily, I'll walk you through two trades. I still have an open position on the Russell, and I still have a short position on Tesla, and I'm going to have to close them right back at where I entered them because of the nature of this market. But you are the exit liquidity. We will talk about what stocks are worth trading today, whether this is a trap day or not, and the things that you really need to follow in the next 48 hours. Paul said he heard us. That's good. That's funny. So anyway, yeah, whether the market's safe and exactly where the smart money is positioning. All right, so I was a little bit behind this morning, and another day in the mines. Taking a look at the green. Here we go. Paying very close attention to BJ, REYN, TYG, and PRME. PRME. So we'll dig into those stocks in 1 second. In addition to that, just take a very quick note at momentum, which on our reading is minus 58. Minus 58. So what does that mean? Well, we're taking the number of stocks that are in breakout territory versus breakdown territory, right? Very important. So we have to measure this from a perspective of, is this going to be setting up a short squeeze or is the worst over? So we have to go through on a Monday morning and all of the different measurements that we look at to get a better sense of what's happening in this market. So we're going to start over at FinViz, right? Sorry, Eric. Good morning. I didn't see you. You might have gotten here at like 6:30 in the morning, and I might have missed you. I apologize. I hope you're having a good day. I hope that the weather down in Florida is not disastrous and hot. It is very muggy here, as always, but that is the state of Maryland at all times. Let's take a look at this real quick. So we're going to go to weekly. We're going to go above 5%. And again, this is the poor man's version of this. We're not doing the full breakdown. I'm not taking you through all of the different mathematical parts of the equation, but I am going to give you the cheap way to do it, and that's simply to look at the number of stocks that are up on the month, up 5% on the week, and in the Russell, and we're going to do a beta of 1 to 2. It's going to deliver us 13 stocks. 13. That's it. That's it, right? Meta is the big dog out of this whole list. Western Digital, obviously very significant as well, but you can look and you can see, based on the market capitalization of these names, you're looking right here somewhere around, I don't know, $2.4 billion, right, in market capitalization. Forgive me, $1 trillion in market capitalization. And as you can see, massive price to earnings ratios, which again doesn't really seem to matter in this environment. 27 all the way up to 66 on Corning, which is a little concerning, right? The fact that Corning, an electrical component, is trading at 66 times earnings, but I digress. All right, so we're going to change this over, and we're going to look at the number of stocks that are down 5% on the week and down on the month. So you end up with 66, and you could see this is a lot of money, right? You've got 3 trillion, 3.4 trillion, and then just keep going, probably 4 trillion. So you're seeing net outflows of a minimum of 5% on $4 trillion in a week, right? And this is important because these are the outliers of the bell curve of momentum. And as we have witnessed in 3 days, very significant drops, 68 stocks in those conditions versus the 14 stocks that are in kind of the breakout, very soft way that we're defining it. So money has been leaving. And on top of that, it's really interesting to note in a chart that I had talked about this morning is this chart. That's the CTA exposure for July at 100%, nearly 100% estimated exposure in equities for commodity trading advisors. So the issue here over the next 48 hours is whether or not funds, big funds, are going to reposition in any significant manner. And as a result, right, you see this 16.4%, 99th percentile on this, right? significant exposure. Why does this matter? It matters because if there is an unwind that happened, if there is an unwind, it can be very short and very brutal and very fast. And I want to specifically speak to this chart because, as you can see, this net exposure transitions when you are witnessing these dramatic downturns that have happened in recent years. And if you look at the very beginning of this, you see that at the start of 2022, well, we had significant net exposure for those funds. And resultantly, we had this sell-off, which transitions with this reduction in that exposure. Then you saw this pop that transpired, and then we saw another big move down. That's the gilt crisis. That was the big event that happened in England in September, October of 2022. And there was a huge drawdown in the summer months, however, after the largest hedge fund sell-off in 15 years, which is right here. We had a rally up that transpired with a move higher on exposure for those CTAs, right? Sell off, rally higher. And then when we moved into the backside of 2023, when that net exposure really declined, this is where the yields, 10-year bond, went to 5%. Now, I'm not saying they're 100% of this. It's a net exposure. Estimated exposure. Equity only. So why does this matter? Well, as you could see, we are at a level we have not seen. And resultantly, if and when they start to unwind these positions, the downside can be very significant. So we're going to be paying very close attention to this over the next few days, simply because traditionally what transpires in big market downturns is you see a couple of days of selling. There becomes this period of panic. You see a little bit of a short-term pop, and then you see a sharp decline, right? And what I'm specifically pointing to is this pattern that has transpired over the last few years where there is selling, a little bit of a pop, and then another drop. And the question now is, what is happening in this equity market as we move towards September? Now, the key thing to watch on top of this is what is happening with executives, and are they buying the dip that has happened in the last 24 hours, or forgive me, 72 hours. I go back to this chart. I argue that this is the single most important chart of all of finance, and that is what insiders are doing with their money when we have these downturns. In December of last year, we saw significant insider buying to selling. The blue line that you're looking at is the 5-day moving average of insider buying to selling based on the time period that we're looking at, which is starting in December of 2024. What you're looking at is significant amounts of executives putting their money down on the table and buying their own stock in periods of economic turmoil or market turmoil. As you could see in December, when we did have a relatively sizable sell-off that ended the year, executives stepped in and bought their stocks hand over fist. The same thing happened in April when we canceled Liberation Day. Significant insider buying, which then preempted this rally that we are witnessing. In recent days, we have seen an uptick in buying power. We've also seen a downtick in selling pressure. Why does this matter? Because if this gets up here and aligns with where we were in previous sell-offs, this is shockingly bullish. So we're going to pay very close attention to this in the next 24 hours because in Tuesday and Wednesday, we're going to see the aggregated filings that have transpired on Thursday and Friday of last week. We need to see what insiders were doing on Friday. If insiders were buying hand over fist on Friday and we see this big move up, that is short-term bullish, and that may actually lead us into another potential move higher as we head through August. And once again, I remain concerned about what comes in September. A lot of questions around the Fed. We're going to get a lot of emphasis again around earnings and what is happening with NVIDIA and what's happening with another large number of companies. But for right now, right, The question is, do you go in heavy and try to aggressively short this market? If insiders are coming in and buying their stock, that has to give you a little bit of pause. And if you are watching this and you see the next thing that I'm going to show you, which is the Magnificent Seven remaining above these key moving averages, I don't want to be first over the wall. Don's very good at being first over the wall. Will be more aggressive. He will be the person leading the first wave off of the boats. I will be on the second or third boat. Say what you will about me. I like to preserve capital at times, and I'm not necessarily committed at this exact moment to aggressively trying to target this market. If we do see a little bit more of a continued breakdown under the 20-day moving average on the mags, I will be looking to short the Magnificent Seven down to at least its 50-day moving average. And the reason for that is you could see we have multiple tests of that 50-day moving average before it finally does break down. So that's the next clue. And then the next thing that we're paying attention to is my favorite and most underappreciated tool in the whole financial system, the absurd FNGD, which is an exchange traded note. I am not going to go into what this thing is. It makes too much sense. And if I try to explain it, you're going to get confused and you may get a bloody nose and hit your head on the table. And I don't want that to happen to start my day. Okay. So do me a favor. Just note that when we break above the 20-day moving average on the FNGD, that is a warning. When we break above the 50-day moving average, that is your O moment, okay? Because as we have seen, when it does break above these levels, this is a unwinding of leverage in the financial system. Once again, all of those FANG stocks are heavily levered stocks. People go out to the repo market, they borrow a lot of money, they take $100 million and they lever it up into a $2.5 billion gross position. On the net side, they are maybe exposed 2 or 3 to 1. But when everything is selling at once and correlation goes to 1, everything is dying off very, very quickly. Well, that's your issue. Sorry, trying to address something. All right. So as you could see, I don't know if we're in this environment yet. All I'm seeing are these little tiny tests. And for now, I'm going to make a decision in the next 24 hours. Now, it doesn't mean that I'm going to be not doing anything today. There's a lot to do. There's a lot to trade. There's a lot of opportunities that persist. And that takes me to the screeners that we have to look at every single day. So the first thing that I want you to pay attention to is this. In this environment where we are now witnessing a market that has just sold off the way it has, if we get short squeeze type behavior, and once again, let's walk through this very quickly. This is important. You've just had a number of companies that are heavily shorted by this market take very specific aim at these names. The stocks with the highest short focus, companies like Beyond Meat. I hate this company. I don't think it should exist. I think they should fire it into the ocean. Maybe put all the packages on some sort of barge and take it out into the New York harbor and sink it, just like they did with all the 1952 Mickey Mantle rookie cards for some apparent reason at the end of the 1950s because they couldn't figure out how to sell them. We can't figure out how to sell bad meat, fake meat. Put it in the ocean. It's going to be great. Now, as you have seen, Beyond Meat has sold off dramatically since its last squeeze. It has moved from $4.76 down to $3. Well, what happens in an environment where you start to see squeeze-like activity? Well, the answer is pretty simple. Beyond Meat may be a very short-term squeeze opportunity because what happens in this environment is what is known as a short squeeze. A short squeeze comes because companies, funds, traders short a stock. What does that mean? Well, they take the stock, right? They go out and they find maybe an ETF. An ETF owns a significant amount of this stock. And the ETF doesn't really care what the performance is because on an ETF, right? And pick any random ETF in the world, whether it's over at Fidelity, whether it's done through Soros, whether it's done through, I don't even know, Vanguard. you have all of these thematic things, right? You have all of these thematic trends, ARK innovation, right? You have all those themes in those ETFs. All right. Well, what they can do is they will lend out the shares simply because the ETF or other fund manager doesn't care what the performance is because they are getting paid on the ratio, right? They're getting paid 2% a year to literally just hold a bunch of stocks. They can lend these stocks out, right? They lend these stocks out. And the importance of this is that person who wants to short the stock takes the stock, sells it into the market. That creates selling pressure. Now, they might pay 3%, they might pay 5%, they might pay 20% to borrow the stock and sell it into the market. Their goal is to profit if the stock price declines. So they borrow the stock, they sell it short, and then if the stock falls from 4 to say 3, they sold it for 4. They can buy it back for 3. They take $1 in profit and they hand it back, the stock back to the person from whom they borrowed it. The issue is that when there are many people all shorting at the exact same moment, what can transpire is a significant, what do we call again, short squeeze, where all of the people who are covering their positions have to do so in the event that the stock starts to rise. So if you have a 3, 4, 5 day sell-off period, shorts may start to cover. And at the same time, that retail army that exists out on Reddit may all crowd in as well, trying to force the stock price to move higher. As a result, you can see a 2 or a 3 day move on the stock, even though the stock has continued to sell off over a duration of time. This type of move may end up producing a retest back to the 200-day or the 50-day or the 20-day moving average. And as a result of that, 40 cents doesn't seem like a lot on a stock, but it is significant on a stock that's trading at, say, $3. So one of the things to be paying very close attention to today, if you're trying to trade a stock like this, is move to a 15-minute chart, move to a 5-minute chart, move to a 3-minute chart, and just pay attention to the price action in the short term. If it starts to move above some of these key moving averages, and this is an example right here, the 15-minute chart, this chart, 15 minutes, is 15 times 20, which means this is the 300-minute chart, right? Or line, 300-minute moving average. If it breaks above that line, that becomes your anchor point. That becomes your stop. And all you're really looking for is a potential move up to 3, maybe even move up to 332. At that point, all of these stocks are in play. All of them become potential reversion plays. All of them become stocks that could potentially break out for a very short duration of time, maybe a day, maybe 2 days. If this market does move in the way that I project that it will in the next 48 hours, which will be a little bit higher, and as a result, we will kind of reset in the next 48 hours as we look at insiders and as we assess the strength of momentum and whether or not capital will flow back into this market. On top of that, what are the other opportunities? Well, as I've noted, I've really preached this time and time and time again, because I think it's a relatively simple way for people to look for breakout and breakdown opportunities. I pay very close attention to 4 indicators, and all 4 of these indicators I watch on the daily chart. Those indicators are the relative strength index. The relative strength index is a price momentum oscillator, meaning it's showing the momentum of price. The money flow index is, again, this is a momentum indicator that is price and volume, and it helps us get a sense of whether or not institutional volume is following the price as well. The MACD is a short-term trend indicator. This histogram, which is very important, will tell us the strength of a trend and the strength of price movement. In addition to that, we have the ADX, which is another important trend indicator as well. And we're always looking for an ADX to be above 25, or above 20, to note that we are seeing a positive trend. When all 4 of these things align, it is signaling positive momentum. So what we're specifically looking for are stocks that are breaking above the midline on the RSI, above the midline on the above the midline on the RSI, a positive, or MFI, a positive move, right? Rate of change on the MACD, so an expanding histogram here, and that ADX. Okay. So on top of that, what we do is we just build a screener and we look for all of the stocks that are meeting these very specific breakouts conditions. So on the momentum side, we only have 12 names that have hit our list today, but RSI moving above 48, MACD turning positive, DMI, the ADX moving positive. We're using the DMI instead of the ADX just for the visualization. Market cap, we want to be above $100 million just simply because we want to find volume. But again, you want to look for the more liquid names. And that EMA, we want to be above that 20-day EMA, looking for breakout strength. Not a lot here. And once you have all of these numbers together, I see your question about the ultimate oscillator. One moment. AWK, which is American Waterworks. I believe it has changed its name since. Oh no, it has not. Okay, good. That's a positive break move. What I'm specifically looking for are the conditions around which this stock is operating. If it is already broken out because of earnings, I've obviously missed something. But AWK is interesting because that's a name that I'm actually interested in owning for the long term, American Waterworks. And even though I might not follow momentum trying to go this way, this is something that I might be more interested in selling a credit spread down here around. For the purposes of trying to take advantage of the market and the fact that I'm more interested in owning this long term. So this creates a unique opportunity because you have positive momentum, but you also have these key lines here above the 50 and above the 200-day EMA and above the 20-day EMA. I might be looking to sell a put and buy a put down here that would allow me the right but not the obligation to purchase the stock, maybe somewhere around 135, maybe even further out. But I would probably go out to December with something like that. AWK is a great company. And it also, the key thing is everything that you were quantifying this morning, you have to then qualify. You have to ask yourself, why is this breaking out? And you have to understand what is the position that I have been provided and why. So why is BKH, which I didn't know what it was until a second ago, Black Hills Corporation. Why is that popping higher? This is a utility, a regulated gas company. And then what is the optimal way to trade that? Is it above its 200-day moving average that might give me more momentum? Or is this something that I look at a chart right here and see, it's really always continually found its bottom, its base around that $56 line. Would I be more interested in selling spreads or selling premium down here on a utility that I may be interested in owning with a 4.7 dividend? It really comes, and then again, the other question is, does it have the volume? Does it have the options? Does it have the potential to do that? Everything has to be qualified. But we're just at the starting point this morning, right? We're simply just looking through those names to prepare ourselves for any opportunities that may emerge. I do not like touching software application stocks. Again, you have this big move up. I would actually be looking to potentially fade this move on Workiva after this pop. One of the key things that you want to pay very close attention to is what else is happening in that sector. Software application stocks have not fared well in recent months, and a lot of that has to do with forward-looking expectations on the job force front. With that weaker jobs report on Friday, concerns about the economy, are all of these different work technology stocks going to be able to hold up? And keep in mind, this is not even a profitable company. So looks like they had a positive earnings event. Yep, there you go. Looks like they topped expectations. Now you got this run. You probably had a lot of short covering on this as well. So if you get extended on a stock like this, overbought for a period of time, a fade looks possible, at least back down to that 200-day moving average. In this environment, of course, you want to look, and it goes the other way. What are the stocks that are breaking down? And there's 168 of these. So you've got a lot to play in this sandbox with. You have a strategy, you have Qualcomm, you have Booking.com, you have LIN, Lindy, you have Starbucks, Marriott, FDX. I mean, there's a lot of weakness here. And all of these names, naturally, as they are in this kind of breaking down condition, and as we see right now, the weakness in the energy markets right now, you see Valero dropping under its 200-day. Well, what's unique and interesting about this? Well, it's already shown us that big negative momentum event that transpired back here under that 20-day, but you're right here at that 200. So if you're interested in shorting oil and gas or shorting energy, Well, your line in the sand comes right back here at around that 135 level, which is the EMA. So you've got a little bit of a cushion. And one of the things that I will always try to do in this situation is instead of buying a straight put, I anchor with the put at the money, and then I sell a put down here, maybe at the 130 level, maybe at the 127.50 level, depending on what the options chain provides. And what I'm specifically looking to do is follow the momentum if it continues downward. But here's the important thing. By selling that other call, or forgive me, that other put, buying a put at the money, selling a put out of the money. By selling that put out of the money, you provide yourself a little bit of cushion just in case the trade goes the other way and the energy sector does turn around. Remember, you don't have control of this. You're simply trying to follow momentum as it emerges. All right, somebody had asked a question in the chat, and it was, what is the ultimate oscillator? Yes, so I do have the ULT down here. The ULT was created by a guy by the name of Larry Williams, and it was created to, he was arguing that there were problems in the RSI. And basically, he was arguing, I believe, that it was like fake divergence signals. So this combines three different periods. It follows the seven periods, 14 periods, 28 periods. And the idea is he's trying to smooth out and reduce sensitivity to short-term volatility and look for, more. I guess a cleaner way to assess price and momentum, and you're going to see there's not a significant amount of difference between these two. It's like looking at it's like it's like looking at identical twins and trying to find a difference. But the average, it's really a matter of buying pressure over the true range for each period. And when you have a bullish divergence signal, prices basically it's following most of the same rules of the RSI, right? The overbought is at 70, oversold is at 30. You don't see a lot of moves on the ULT into those levels. And again, I think it's just a matter of it just being a little bit smoother. This is slower reacting than the RSI, and it's also it's less popular. People don't use it as much. It's less self-fulfilling, if you will. And it doesn't really work well in a low volume chop environment. So it's good for traders who are looking for divergent setups, but it's not like ultimate in practice. They just called it ultimate. It's like saying, I'm the #1 baseball player in America. Prove me wrong. But pair it with volume weighted average price, pair it with VWAP, anchored VWAP, support levels, resistance levels, and obviously utilizing it. It's just one more thing to help build conviction, I think is very important. As I've said time and time again, if you're new to trading, or you've been trading for a long time, or you've been watching a market for the better part of 10 years and you're going, how in the hell is this market going higher when economic numbers are worse? How is the market moving higher when interest rates are elevated? What's important about having all of these indicators is having conviction and noting that the story of the stock or the index is told through the technicals. It's told through the indicators. Some people aren't technical traders. I get that. I think, though, that it's important to keep an eye on it because price tells the story of the market at all times. And what can happen so often is if you're not watching this stuff, if you're not paying attention, if you're not looking for these, multiple breakouts at the exact same time, what transpires, which is so kind of frustrating for a lot of people, is that maybe 2 weeks ago, we were talking about how it's a great time for refineries because oil prices aren't as elevated, crack spreads are coming down, or crack spreads are improving, which is the difference between what they buy the oil for and what they're able to sell their refined products for. That, there was optimism around trade. And now all of a sudden, it's 2 weeks later, and we're talking about OPEC raising its output in September and concerns about trade and a weaker economy. The narrative has shifted, but the price had already moved, right? And this is the key thing that what I say when I talk about momentum and why I say constantly to watch these types of indicators, because by the time the price is here, and I this is going to sound a little funny, like It's already happened, right? So you're going to see in barons during a crisis, hey, this is a really bad situation. You know, the markets are not going to survive. People were talking about the Great Depression again on April 7th. And then everybody's all of a sudden very, very bearish. But the reality is the price had already moved, right? We're too late. So the news is behind, the journalists are behind, the reports are behind, the sentiment has shifted, and now people who are already short a position or long a position, however you want to define it, now they're out there talking their book. Now they're out there saying, it's going to get worse. It's going to get worse. It's going to get worse. And what's your inclination? Sell. And what are they doing? Buying. It's all a game. And you're playing a game, and you have to be aware at all times that price is telling you what is coming next. Price is telling you what is coming next. So stay out in front of it. Watch the indicators. And sometimes it's going to defy logic from what the actual narrative is of the market. It's going to defy logic. You will have an environment where everybody could not be more bullish in the history of bull markets. We just came off of 60 solid days of the S&P 500 above its 20-day moving average. It takes a lot of money and conviction and optimism to do something like that. But here's the thing. The previous run, the one that this one just barely got to but didn't align with, 2020, leading into 2020. The run that we had into January of 2020. You could not have been more bullish at that time. And then something was wrong. And then, even though we were not in an environment where everybody thought that something negative was going to happen, selling actually started on February 21st, 2020. That's when the selling for COVID started. That's where the deleveraging started. We didn't shut down the economy until mid-March, but the selling had already started. So keep this in mind. Price tells the story. Oscillators tell where momentum is moving. Pay very close attention, even if it defies logic, even if it goes against the narrative that's on CNBC or in Barron's or the Wall Street Journal. If the move has already started, get on the wave and ride that wave. And don't look back, because what will happen is 2-3 weeks from now, everybody will suddenly be bearish, or everybody will suddenly have a different sentiment. We want to be out in front of this. Now, as we monitor this from a macro perspective, and this is very difficult, we don't know what's going to happen in the next 2 to 3 days. We can actively trade the stocks that are on our watch lists. We can actively look for reversion trades. We can actively short things that are breaking down, go long things that could go up. We have short squeeze opportunities. But at the same time, if something bigger is happening in this market, we're not going to know for a couple of days, because what I would anticipate is if we did have something more significant, you're going to see some buying pressure into this market. And then people who are going to want to sell, like those CTAs that we mentioned, will sell into that pressure. And that is what can lead to these types of events, or what we saw in June 2022, the largest hedge fund sell-off in 15 years. Okay, guys, this is a little bit more macro than what we usually do, but I just want to note this. Listen, I understand on the dark background, man. And man or woman or whomever you are, I apologize. But the thing is here, I get feedback on both sides on this. I get feedback that, like, some people want things dark, some people want them light, and I gotta stick with what the people want. This is a democracy, allegedly. So if that's the case, except for Don's at the head of the ship. But I'll have to ask Don. Don, if you want me to do light, you let me know. You want it to stay dark? You tell me. Don will tell me in a moment. All right. It is 9:21. Don's going to be coming up momentarily. It's going to be a very busy week, so be very active. There's going to be trades setting up today. Join us in our member room. We're going to be live pretty much all day today, and I will be back looking for some opportunities as they emerge. Pay very close attention to our morning email that we send out. If there is anything significant that I'm seeing, I will make sure that you know it. I hope you guys have a wonderful trading day, and I will see everyone else tomorrow, 8:45 at Market Masters. All right. All right. See you guys. Have a good day.